Good morning, traders. This is Evelyn from Astra Montis, and I'm here to bring you the latest insights for the week of May 13th to May 17th, 2024. Let's dive into what to expect in the upcoming week. In today's analysis, we will explore a series of key economic updates and policy shifts from around the globe. Our focus will span from the evolving U.S. inflation trends and the Federal Reserve's monetary policy expectations to the Bank of England's dovish pivot, Australia's monetary stance, China's economic indicators, and Japan's economic health and its impact on the yen. These topics offer a comprehensive view of the current financial landscape, illustrating how global markets interconnect and respond to changes in economic policies and growth indicators. Looking ahead to next week, market focus will shift to the U.S. Consumer Price Index (CPI) for April, set to be released on Wednesday. Preliminary data from S&P Global PMIs indicate that output prices rose in April, albeit at a slower rate than in March, hinting that inflationary pressures might be moderating. Furthermore, a significant reduction in year-over-year oil price changes could further dampen headline inflation risks. These developments will be crucial for traders and policymakers as they assess the trajectory of future monetary policy adjustments. The Bank of England's monetary policy announcement took a notably dovish turn, maintaining the interest rate, but with a surprise as two members voted for a 25 basis points cut. The accompanying statement highlighted an intention to closely monitor upcoming data releases, particularly focusing on signs that inflationary pressures are diminishing. This dovish stance was further underscored by downward revisions in inflation forecasts, leading officials to anticipate a continued easing of inflation rates. The pound experienced a slight decline following this announcement, as market participants adjusted their expectations, now more firmly anticipating a rate cut as soon as August. Looking ahead to next Tuesday, the UK is set to release employment data for March, with a keen market focus on wage growth. A softening in wage growth could further support the bank's projections of slowing inflation. If wage increases do show signs of decelerating, this could potentially prompt the pound to continue its decline, as traders might begin to speculate on the feasibility of a rate cut as early as June. This upcoming data will be critical in shaping monetary policy expectations and market movements in the near term. After the Reserve Bank of Australia (RBA) opted to maintain its neutral stance, Aussie traders are now keenly awaiting the upcoming economic indicators, particularly the wage price index due on Wednesday and the employment report on Thursday. These releases are pivotal as they follow a first quarter where inflation was more persistent than anticipated, prompting traders to adjust their expectations from anticipating rate cuts to now considering the possibility of rate hikes. This potential monetary tightening comes at a juncture when other global central banks are contemplating rate reductions, potentially positioning the Aussie for gains. Additionally, should the U.S. inflation data set to be released on Wednesday reveal encouraging trends, it could boost risk appetite further, enhancing the Aussie's appeal as traders might increase their bets on a Fed rate cut. As we look towards the second quarter, the performance of the Chinese economy remains a critical focal point for global market sentiment, particularly affecting currencies like the Aussie. Next week promises to provide crucial insights as China, the world's second-largest economy, it is set to release its industrial production, retail sales, and fixed asset investment data for April. While Q1's robust GDP growth reduced the immediate pressure on Chinese policymakers to implement aggressive stimulus measures, the upcoming data will be vital. If the indicators suggest a slower start to Q2, it could reignite concerns about the stability of China's economic recovery. Such developments could potentially impact the Aussie and the Kiwi negatively, particularly if the Aussie relinquishes any gains made from positive employment data earlier in the week. This Thursday during the Asian morning, all eyes will be on Japan as it releases the first estimate of its GDP for Q1. Market watchers are keenly waiting to see if Japan's economy maintained its growth trajectory or slipped back into contraction. The outcome of this report could significantly influence the yen, particularly if the economy shows signs of contraction, which might push the yen closer to the critical 160 per dollar level, a point that recently prompted governmental intervention. Despite potential interventions, a significant and sustained yen recovery seems unlikely without robust economic growth. If the Q1 report reveals another quarter of contraction, it could fuel speculation that the Bank of Japan BOJ might delay any anticipated rate hikes even further. Conversely, if the GDP data indicated accelerated growth, it might boost market confidence, encouraging investors to increase their bets on a summer rate hike by the BOJ. Such a scenario would be crucial for the yen to start a meaningful recovery. In conclusion, our exploration of diverse economic environments and policy directions across major economies has highlighted the intricate balance policymakers strive to maintain. In the face of shifting economic realities, from the US to Japan, each region presents unique challenges and strategic responses that not only affect domestic markets, but also resonate across global financial systems. Understanding these dynamics is crucial for stakeholders to navigate uncertainties and capitalize on opportunities in a complex global economy. To conclude, as we navigate through this week's trading landscape, it's essential to closely monitor these significant updates. We appreciate your confidence in our insights and wish you prosperous trading in the days ahead.